The first quarter of the year is now behind us. Let's look at how Sifter Fund has performed. So during the first quarter, Sifter Fund performed 14.7% gain after all fees, and it outperformed the global index ETF by 4.1%. If we look at the last 5 years, and the Sifter Fund has performed 116%, and the global ETF has performed roughly 76%, and the Sifter Fund has outperformed the global ETF by 40 percentage points. So Olli, what explains this kind of outperformance?
Yeah, well, we can divide it into two main factors. So one is kind of so-called allocation effect. So we have this overweight in information technology sector shares, and those have overperformed quite noticeably over the past few years. And while we don't have kind of an active allocation strategy, apart from excluding banks and excluding raw materials, it's not exactly an accident that we have this kind of allocation in the end, because our investment process favors companies with good growth prospects, with strong competitive advantages and kind of solid financial positions. And those kind of companies have been kind of easier to find on average from the information technology sector than from other sectors. But the other factor that explains that kind of overperformance is then the good kind of positive selection effect on average. So that basically means that we have managed to choose kind of successful, kind of overperforming shares in those other sectors. So that has been true on average for almost all of the other sectors, apart maybe from consumer discretionary, where it has been indeed more difficult than average to kind of find reasonably priced quality companies. But yeah, there's kind of some
allocation effect and selection.
Yes,
in a good companies. Well, coming back to this first quarter, so there are lots of fluctuation in the earnings announcement, but what were the top performers in this quarter?
Yeah, the top performers were Sony Corporation, Tomra, and Disney. So indeed, 3 companies from three very different industries. But if we start from Disco, so basically it's the general optimism around AI that is obviously improving the investor sentiment around Disco, but more importantly, the company itself said that they have seen that kind of demand, AI-driven demand, strengthening over the past quarter still. So really positive commentary. There was some slight missteps in another growth driver, which is the power semiconductors, where there was a little bit of a slower quarter, but Disco expects that to kind of reverse quickly. And overall, they forecasted about 25% quarter-to-quarter equipment delivery growth. So yeah, positive commentary. Regarding Tomra, well, the quarterly report basically reflected that these macro headwinds that the company has experienced are easing. And then another kind of positive driver was that the EU, there's signs that EU legislation is kind of becoming more, kind of turning more towards a direction where we would have more of these kind of reverse vending machines being kind of obligatory in different regions.
And maybe it's good to remind that Tomra Systems is a Norwegian waste management company.
Yes.
And it's happened to be our second newest business also so it was a nice performance for the newcomer, so to say.
Right from the start. Yes. Yeah. Yes. And Disney, well, the positive thing there was that their streaming business made significantly less losses, and also these losses are expected to narrow further in the future. So positive developments there as well. So
those were the top performers. Maybe one reason for a nice outperformance during the first quarter was also that we were able to avoid disappointments, kind of. But of course, there are always the bottom performers. So which 3 we had this time?
Yeah, for the most part, there were no big disappointments. So the kind of bottom three players were Sony, Northwest, and Deutsche Börse. And yeah, for Northwest and Deutsche Börse, really there wasn't that much of a change in the share price. They're more like moved sideways, you could say. But well, for Sony, there was a bit of more of a drop in the share price. And basically, what's driving that is that the demand for these new gaming consoles, PS5s, basically are just the sales are not as high as the company was themselves expecting. So that's that's going to kind of limit game sales in the future. So yeah, we're monitoring that. But yeah, apart from Sony, really there were no major changes or kind of declines in share price.
During these first 3 months, I think we were quite active, maybe more active than typically regarding the changes in the portfolio. And you mentioned a couple of already invested companies like Tomra. But how was the effect on the allocation? So even though we don't have like allocation criteria, as you mentioned, but there were a few changes regarding geographical and sector allocation. So yeah, how has it changed?
Well, yeah, from the end of last year to the end of this quarter, well, geographically, the biggest change is that there's 3 percentage point increase in our weight in Western Europe. And the main driver there is our investment in Tomra. And there's the second biggest change is the 2 percentage point decline in terms of Asian shares. And that's because we sold a bit of our holdings in Sony Corporation. And yeah, the other changes were quite small. If you look at by sectors, well, we still have a pretty significant kind of stake in information technology, but that weight of that still fell by 4 percentage points. And the reasons behind that is that we reduced Cisco, we sold Cisco Systems, and we sold Verisign. So that explains the changes there. And industrials, there the weight increased a bit, again due to Tomra. And in healthcare also, we saw some increase there, and that's due to our another new investment this year. That's Mettler Toledo.
So if we look at the, let's say, last 9 to 12 months in the portfolio, one could argue that we have decreased U.S. stocks a bit. And at the same time, we have decreased also the positions of IT technology companies, at least a little bit.
Yeah, the active decisions really have kind of moved the portfolio in that direction. Although it's fair to mention that obviously information technology shares overall have appreciated at quite a brisk pace, so that has a little bit cancelled our actions. But without those actions, the share of information technology would be even bigger.
Yeah, that's right. That's right. Well, let's look at the key portfolio changes. So as mentioned, we were quite active during these first 3 months. And one thing what we did, we updated each and every business we have invested, and we gave a ranking order for the businesses. And based on that, we made few decisions. So we decided to invest in Tomra Systems and Mettler Toledo. And since you are the lead analyst for the Mettler, so what does Mettler? What is the business?
Yeah, it's a company with a strong Swiss origins and still a lot of operations there, but they are now listed in the US. And the company is known for making a broad range of precision instruments, but particularly kind of these high precision laboratory scales. And to give you kind of idea of, or balances, you could call them, and to give you an idea of what kind of balances or scales they are, well, the prices for those for laboratory environments, the prices start from a few thousand euros, and the prices go all the way up to tens of thousands of euros. And the accuracy is really quite astonishing, though. So the smallest changes in weights that they can detect at best are about like 1 millionth of a gram. So that's the kind of instruments we are talking about. And Yeah, these instruments are usually used in laboratories. So about half of the revenue originates from some kind of laboratory application environment. And the largest customer groups consist of these pharmaceutical companies and biotech companies. So that's basically what the business is about.
So, but you started to analyze Mettler Toledo end of last year. So, what catch your attention? What characteristic of the business you kind of like thought that there's something really interesting?
Well, definitely the strong and steadily improving margins. So gross margins are now at about 60%, operating margins at around 30%, and returns on invested capital, which is probably kind of the most important or the most useful metric, that's around 30 to 40% over the past 5 years. So higher returns indeed.
Impressive business and figures.
Yes, and the steadiness and the steady improvement trajectory really is what caught my eye. And but there are other things then that also kind of fill the Sifter criteria, and which you need a little bit of time to kind of discover. Those numbers that I mentioned are easy to see, but there are competitive advantages in play here. So. The company has indeed a very extensive range of instruments for laboratories, particularly for quality control laboratories. So they are probably able to bundle and all that, leverage that broad offering there. But they also develop software that can be used to operate all those instruments. And in that way, kind of streamlines the automation of a laboratory and kind of definitely helps with the data management when you have kind of one software umbrella that you could use to kind of control all the instruments and the data coming out of them. The other advantage that they have is that they really seem to be kind of the leading player in the niche market of weighing instruments. So particularly in the laboratory scales, there they have about like 50% market share. But also in terms of other kinds of general scales and weighing equipment, they really seem to be a market leader. So there's kind of advantages there in terms of scale, in terms of having a large installed base, which is kind of efficient to service all those advantages.
So one would argue predictability. That's one competitive advantages, and then solid business figures over a long period of time.
Yeah. Indeed. So really quite predictable. So no customer is more than 1% of revenue. So there's very little volatility from that. Revenue originates in a very kind of consistent, broadly diversified way from around the world. They have production capabilities around the world. So that's just kind of makes it a very Sifter-like business.
So Mettler Toledo and Tomra Systems, the new incomers in the portfolio. Well, in order to make those new investments, we had to exit or divest few long-held investments in the portfolio or from the portfolio, and we had a Cisco Systems and Verisign.
Yes,
both of them we have owned for a long time.
Indeed.
So what were the main reasons to divest those companies now?
Yeah, to kind of give the viewers some background. So we first invested in Cisco Systems in 2012 and in Verisign in 2016. So really long time indeed. And from those first investments, those companies actually offered returns that were somewhat higher than what the Sifter portfolio overall managed. But this kind of overperformance that they achieved really was kind of seen before 2020. So after 2020, they kind of struggled, kind of moved sideways while the whole Sifter portfolio moved up. So there was the issue of slow growth there. So for example, if we first consider Cisco, so they haven't really managed to gain substantial share in the data centers, or particularly in the cloud computing infrastructures of those large cloud computing players. And that's where the growth would have been. So they failed to kind of capture that growth. And while they are strong in other environments like campus networks, that's not really where the growth was. So Cisco has the top line has largely stagnated due to that. They have managed to grow profits, but that's just due to the changing business mix. So they are changing from hardware to software. So the profits were actually growing, but if the top line doesn't grow, there's just eventually going to be an end to that kind of profit growth. And Verisign, the websites that end in .com, really the rate at which those are created isn't really growing at the same rate as it did before. The company's kind of ability to raise prices has been locked for a few years now.
So if we compare these two, Cisco is very cheap, in a way cheap valuation metrics. And one could call it as a value trap in many ways because the business figures are still quite nice.
Oh, they are.
And the valuation is quite low, but the problem is with the growth.
Yeah.
And Verisign, well, it's never been cheap. It's been quite a hefty valued company, but no growth anymore. Or at least the growth is more modest.
Yeah, indeed. So, they're not obviously not terrible companies. They have a lot of kind of quality characteristics, but they just miss that growth component there. If we think about Cisco, they're really quite predictable, at least over periods of like 5 years, when those fluctuations in the hardware upgrade cycles are kind of smoothened out. So it's actually quite predictable. High margins, as you mentioned, and they have pretty strong position in the kind of slow growing areas where they are present. Quite stable financial position.
Well, one could ask why we didn't sell earlier, because we can see that the outperformance was over like 3 years ago.
Yes. Well, first of all, getting the good picture of the underlying growth is not super quick and easy for Cisco due to those fluctuations in the hardware upgrade cycles. But a more important reason is that we had other companies that we had to prioritize in terms of selling. So before really finding new alternatives, kind of quality companies at reasonable prices is a slow process. So we can't just immediately sell companies that we don't like because we also need to maintain sufficient amount of diversification in the portfolio. Those are kind of the main reasons. And also, for example, Cisco was not perfect, but somewhat satisfactory until now. But in late 2023, they actually engaged in this big acquisition, acquiring Splunk. That will burn their net cash. And it's also a worrying sign because it's an unusually large acquisition for Cisco.
And that's typically a red flag to us that there's burning the cash and buying something what is really big.
Yeah, and it also may break the predictability of the business, particularly if you see it as a signal that they try to accelerate growth through a major acquisition. So who knows what comes next year then? Yeah. Now we had to prioritize Cisco and we sold it.
And luckily we found Tomra and Mettler.
Indeed.
So that kind of like helped the replacements. Also, based on the earnings update, what we did for the portfolio, we reduced some businesses, and maybe the biggest reduce was for Disco System, the Japanese semiconductor equipment manufacturer. So what was the reason? Because the Disco was the best performer for this quarter and also for the last year. So now why did we reduce that?
Yeah. First of all, we reduced Disco kind of towards the end of February, so kind of on the second half of this quarter. So we indeed did benefit materially from the share appreciation this quarter as well. And we did reduce that by 1/3. So we still have actually a significant amount of Disco shares. We still think that it's a quality company that benefits from the fact that these manufacturing methods of semiconductors are changing. The materials that are used are changing into a direction that benefits Disco more. So one driver being AI, which is kind of the development there is based on the kind of AI processors where you need discuss equipment more. The memory architecture there, the high bandwidth memory, you need to manufacture it in a certain way. So that's basically the quick picture.
Yeah.
So accordingly, we did raise our forecasts for Disco's profits. So if you look at the 2027 forecast that we have, well, we hiked those profit forecasts by 80% over the past year, but the share price has increased by over 3 times. So the valuation is just rather challenging now. So we would like to first see Disco to actually deliver in terms of these growth expectations before we continue with the kind of stake that we had earlier.
Right. So we could argue that selling, reducing or increasing some stocks, it's our normal active management operations, what we do maybe 4 times a year, so to say.
Yeah.
All right, very good. Thank you, and thank you for following and watching our status report for the first quarter of 2024. And please remember, we have mentioned few names, the companies we have divested or we have purchased during this first quarter or before. These are not investment advices, but only the businesses we in Sifter we have invested or divested. Thank you for being with us.